If you have ever purchased a home, settled a complex estate, or moved significant capital into a private equity fund, you have experienced a peculiar form of temporal dissonance. We live in an era where data travels around the globe in 200 milliseconds. You can stream high-definition video from a space station. You can execute a high-frequency trade in a fraction of a heartbeat. And yet, the actual transfer of the title to your property, the legal proof that you own the ground beneath your feet, still takes 30 days, a dozen intermediaries, and a mountain of physical paper that looks remarkably like it belongs in the 19th century. We call this the friction tax. It is the invisible cost of a legacy system that no longer fits the speed of the modern world. It is the cost of lawyers, escrow agents, title insurance, and manual reconciliation. It is the price we pay for a world built on blind trust rather than verifiable truth. Welcome to the horizon. Today, we aren't talking about the latest speculative crypto asset or the volatility of the week. We are looking at something far more profound and, frankly, far more inevitable. We are examining the great upgrade, the transition of the world's $300 trillion in real-world assets, from gold and real estate to private credit and fine art, from fragile paper silos into the immutable architecture of code. For the seasoned investor, this isn't about chasing a trend. It's about understanding the new plumbing of the global economy. This is why your assets are moving to the ledger. To understand where we are going, we must first understand that the history of civilization is, at its core, the history of the ledger. Every major leap in human cooperation was preceded by a leap in how we record who owns what. 5,000 years ago in Mesopotamia, we used clay tablets to track grain shipments. It was a primitive ledger, but it allowed for the first complex trade networks. In the 14th century, the Medici family and the merchants of Florence didn't just invent banking. They popularized double-entry bookkeeping. This was the code of the Renaissance. By recording debits and credits in a way that had to balance, they created a system of internal verification that allowed capital to flow across borders with a new level of confidence. This single intellectual breakthrough, this ledger revolution, laid the groundwork for the modern corporation and the global age of sale. In the 20th century, we moved those ledgers into the digital realm. We built massive databases, silos managed by banks and clearinghouses, and we called it progress. But here is the catch. These digital ledgers are not common. They are private, proprietary, and they don't talk to each other. When you send money or transfer a deed, your bank updates their private ledger. Then they send a message to the other bank, who then updates their private ledger. It is a game of digital telephone. We have traded the physical paper for digital paper, but the underlying logic is still based on manual reconciliation. We are still living in the era of Excel-based trust. We are now standing at the edge of the next great leap. The transition from private, siloed ledgers to shared, universal ledgers. The current system is reaching what engineers call a complexity limit. Our global financial plumbing is a patchwork of 1970s mainframe computers and modern web interfaces held together by sheer willpower and trillions of dollars in float. Consider the concept of T+2 settlement in the stock market. When you click buy, the transaction feels instant. But in the background, it takes 2 full days for the stocks to actually change hands and the cash to settle. Why? Because the back-end infrastructure is so fragmented that it takes 48 hours for all the various ledgers to reconcile and agree that the trade actually happened. This is not just an inconvenience. It is a massive source of systemic risk. In periods of high volatility, that 2-day gap, the settlement risk, can become a chasm. We saw this during the 2008 financial crisis and more recently during the meme stock frenzy of 2021. When the system can't reconcile fast enough, liquidity dries up, and the plumbing starts to burst. We also face the transparency paradox. We trust institutions because of their names, their marble pillars, and centuries of history, but we have no way to actually verify the health of their balance sheets in real time. We rely on quarterly audits, which are essentially snapshots of a moving train. The paper system is opaque by design. It requires us to trust the institution rather than the math. As our assets become more complex and our markets more global, this blind trust model is no longer sustainable. The legacy system isn't just slow. It's fragile. This brings us to the core of the great upgrade, the smart wrapper. To understand the future of your portfolio, you must move past the noise of cryptocurrency as a speculative instrument and look at the technology as a new container for value. Imagine a wrapper, a piece of programmable code known as a smart contract that surrounds a real-world asset. This wrapper doesn't just represent the asset. It is the digital manifestation of the asset's legal rights, its history, and its rules of engagement. When we talk about real-world asset, RWA tokenization, we are talking about taking a physical gold bar, a commercial office building, or a treasury bond, and placing it inside this digital wrapper. Once inside, the asset gains superpowers. It becomes programmable. For example, a tokenized bond can be programmed to automatically pay dividends to whoever holds the token, without the need for a bank to manually process the payment. A tokenized piece of real estate can be split into 1,000 pieces, allowing for fractional ownership while the ledger handles the complex distribution of rent and taxes automatically. This is why we call it an infrastructure upgrade. We aren't changing the asset itself. The gold is still gold, the building is still steel and glass, but we are changing the vehicle in which that asset lives. We are moving from a dumb vehicle, a paper deed in a filing cabinet, to a smart vehicle, a digital ledger that is transparent, immutable, and 24/7. This isn't a departure from traditional finance. It is the ultimate optimization of it. It is the move toward a world where ownership is as fluid and verifiable as a text message. We often speak of liquidity as if it were a natural property of an asset, like the weight of gold or the yield of a bond. But in reality, liquidity is a function of the pipe it travels through. For decades, the most stable assets in the world, commercial real estate, private equity, and fine art, have been trapped behind a wall of high-friction logistics. We call this the illiquidity discount. If you own a piece of a premium office tower in London, you cannot sell 5% of your holding Tuesday afternoon to cover a tax bill. You are locked in not by the value of the building, but by the antiquity of the paperwork. Moving these assets to code, the process we call tokenization, fundamentally changes the physics of ownership. It allows for the fractionalization of the world. Imagine a scenario where a $200 million private credit fund is represented not by a thick stack of legal binders in a vault, but by 1 million digital units on a ledger. Each unit carries the same legal rights, the same claim on cash flow, and the same seniority. For the investor over 40, this isn't about day trading skyscrapers. It is about the democratization of institutional-grade stability. It means that the diversification once reserved for sovereign wealth funds, accessing private markets and non-correlated assets, becomes as seamless as buying a blue-chip stock. We are removing the gatekeepers of entry, not by subverting the law, but by automating the compliance. When the ledger handles the cap table, the minimum investment threshold can drop from 7 figures to 4, without increasing the administrative burden on the issuer. This is the liquidity revolution, the movement of value from stagnant pools into a global, flowing current. There is a profound irony in our current transition. The move to a digital, invisible ledger actually provides more transparency than the physical world ever could. We call this the transparency paradox. In our current legacy system, we rely on institutional trust. We trust the bank because it has a marble lobby and a century-old name. But as 2008 taught us, marble lobbies can hide black box risks. We were trading mortgage-backed securities without anyone truly knowing what was inside the box until it was too late. When assets move to code, we transition from institutional trust to algorithmic trust. On a public ledger, the look-through capability is total. You don't have to take a counterparty's word that they have the collateral. You can verify the math yourself, or use tools that do it for you, in real time 24/7. This isn't about exposing your private business to the world. It's about creating a verifiable trail of provenance. From the moment a land deed is wrapped in a digital token, its entire history, every lien, every transfer, every tax payment, becomes an immutable part of its digital DNA. This eliminates the title insurance industry because the title is no longer a question of opinion or lost paper. It is a mathematical certainty. By moving to code, we aren't making the system more abstract. We are making it more grounded in reality. We are replacing the trust me of a broker with the show me of a ledger. It would be intellectually dishonest to suggest this transition will be seamless or immediate. As an analytical peer, I must steelman the opposition. The hurdles are significant. First, there is the regulatory labyrinth. Our current laws were written for a world of physical certificates and regional jurisdictions. They do not yet know how to categorize a global, programmable asset. We are in a period of regulatory lag that creates a fog of uncertainty for the institutional investor. Then, there is smart contract risk. While math is objective, the humans who write the code are not. A bug in the digital wrapper of a multi-million-dollar asset is a catastrophic failure point. We are currently building the audit and insurance layer of this new world, the equivalent of the building codes and fire inspections that made modern skyscrapers possible. Finally, there is the sheer inertia of legacy systems. Trillions of dollars are currently managed by people who are 5 years away from retirement and have no incentive to learn a new plumbing system. They will fight to keep the manual high-fee status quo for as long as possible. This is why I view this as a 10-year transition, not a 10-month trend. We are not looking for a crypto summer. We are looking at the slow, tectonic shift of the world's financial infrastructure. The Great Upgrade is a marathon of integration, requiring patience, rigorous due diligence, and a tolerance for the messiness of structural change. As we stand here, looking at the Great Upgrade of ownership, it's important to zoom out. This is not about chasing the next volatile asset class or trying to outsmart the market. It is about recognizing a fundamental shift in how the world defines, tracks, and moves value. The fragility of paper is being replaced by the durability of code. For the seasoned investor, this is a reassuring development. It suggests a future where markets are more liquid, more transparent, and less prone to the systemic black box failures of the past. At the horizon, we don't look for the quick gain. We look for the new plumbing, the structural changes that will define the next 20 years of wealth preservation. The migration of assets to digital ledgers isn't a departure from traditional finance. It is the ultimate optimization of it. It is the move toward a world where ownership is as fluid, verifiable, and permanent as the code that governs it. Positioning yourself for this upgrade requires no frantic action, only a sober understanding of the direction the tide is moving. The future of ownership isn't something to be feared. It is something to be understood. Because on the horizon, the view is always clearer. Thank you for your time.